Hello, real estate mindset community, and welcome to this morning's live market update report. I got some amazing stuff to go over with you guys today. We're going to start by taking a look at corporate bankruptcies absolutely skyrocketing right now, near where the great financial collapse levels were. So we're going to go into that. And then we're going to go into a video from Team Kennedy. Now, the reason I'm going to play this video is I believe that as we go into 2024, pretty much every politician that's running for presidency is going to be talking about the housing market and how they can make it more affordable. So although I'm not going to cover politics, all right, I promise I will not cover politics in that way, but I think it's important to understand what these people are saying that they're going to try to do going into the presidential election. So we'll listen to that video and talk about whether or not we think it's a good idea, what they're saying. Now, after that video, we're going to go into a full deep dive of the market. So we'll follow the money, we'll follow the interest rates, and we'll continue to keep our hands on the pulse of the housing market. Now, my second video, you guys, absolutely love this video. And I think you guys are going to get a lot of value from our second video. It's going to be about 7 minutes. It's from George Gammon from Rebel Capitalist. He actually did a video last night. I watched this video last night. He's going to go into basically the laws of supply and demand, and he's going to tell us why he believes the housing market is actually going to crash up to 40% in prices. Very good video, you guys. Really love that channel. That's from Rebel Capitalist. I'm only going to go into the first part of the video, but again, tremendous value there. I think we can all learn from what he was saying, and I think it's going to be eye-opening. Essentially, guys, we don't need that much inventory for house prices to collapse. Understand that the prices are propped up for many reasons. One primary reason is historically low inventory. Once that changes, prices are going to come down. We know this. It's like a fact. The question is, and what people are arguing about is, where are we going to get the forced selling? And I'm trying to explain to people, we have forced selling every single year. Forced selling is a normal part of the housing market. And you guys, we're only off about 600,000 in active units. Now, I listened to, the head of the National Association of Realtors say we're shy 4 million units. That's crazy talk. We are not shy 4 million active units. We're missing about 600,000. That's it. And we can get that inventory in a snap of a fingers, especially if unemployment becomes unhinged. But anyways, guys, that's going to be our second video. Our third video, I'm going to go into what Glenn Kelman is saying at Redfin. Glenn is on the campaign trail again, and I'm concerned for him. He's basically saying things when his own company is reporting things that are different from what he's saying. So kind of blown away by what Glenn is doing, guys. But we're going to get started right away. Let me put some timestamps here. And again, I really appreciate you guys joining me. I really hope you guys get an overwhelming amount of value here. But let's start with this article. But real quick, I threw up a comment. I forgot about this comment up here. So basically, Night Cree is saying, are we really looking at most recent year mortgages being over 50% net DTI? The thing is, Night Cree, is mortgages right now are over 50% DTI. On FHA mortgages, you can go 56.99% debt to income ratio based off of gross income. On conventional, you can actually go up to 50%. So we have mortgages right now that are over 50% debt to income ratio right now. But anyways, guys, let's start here, because obviously commercial financing, there's a huge meltdown, and it's actually going to get much worse. There's a huge meltdown in commercial financing. And the thing is, guys, that's going to further strain credit tightening, and that's going to further push unemployment. So it's like a double whammy. Yes, it's a little bit slow. There was a lot of money pumped in, but take a look, guys. I'm going to visualize this just so you guys can see where we're at right now with U.S. corporate bankruptcies, okay? So I'll explain this here in a minute. I just want to make sure you guys can see that okay. Let me remove this. I'm sorry about that, y'all. So let me move my picture over here, okay? All right, now let me explain what this graph is. This is going back to 2010, first of all. Now, this crossed section line here is basically showing us what bankruptcies we're up to as of July of that year. Okay, so as of July of all of these years, okay, here's the number of corporate bankruptcies. So let's look at 2023 right here. So right now, what this is saying is, as of July, this is only going to July. It's not even counting August. It's not counting September. We're sitting at 402 corporate bankruptcies. If we go back in the space-time continuum, just to compare where we were at during lockdowns, we are almost past the level we were at lockdowns. and we're not in lockdowns, you guys. And then if we keep going back, the last time we had this level of bankruptcies was during the great financial collapse starting in 2010. So we have an alarming amount of corporate bankruptcies going on right now. Essentially, that trajectory is skyrocketing. And again, you guys, we're not even in lockdowns, and we haven't even started the recession. In 2010, we were through the recession. Things were still breaking. They're trying to prop things up, but 2010 was really bad. That's what I'm trying to say. 2010 was a really, really bad year. 2009 was also a bad year. But look at this, guys. The trajectory of these trends is absolutely alarming. And let me show you guys some of the companies, billion-dollar companies, that have already gone bankrupt this year. Okay, so billion-dollar bankruptcies. So far this year, there have been 16 companies with over $1 billion in liabilities that have filed for bankruptcies. Okay, now again, when they file bankruptcies, it also hurts the lender. And when it hurts the lender and they make less profit, they're going to get tighter with the credit. So again, you guys, this is a double whammy: credit tightening and additional unemployment. But look at the first one. I don't know about you guys, but the first one hurt me because as a child, I went to Party City all the time. Party City, you guys, is in bankruptcy right now. And if we go through this list, there other random stuff like Diamond Sports Betting, Bed Bath & Beyond. Can't believe Bed Bath & Beyond went out, but a lot of companies, you guys, healthcare companies, aircraft, 2 aircraft companies, which was really surprising to me, Westco Aircraft and Voyager Aircraft as well. I'm sorry, Voyager Aviation as well. But a lot of stuff is going on right now, you guys, when it comes to, the hardships of the corporate world. And honestly, it's going to get worse, and it's going to get, it's, who knows how much bailout is going to happen from the Federal Reserve. I think that's going to be a huge factor moving forward. But again, you guys, if things stay as is right now, it's only going to get worse and worse and worse. And in the meantime, remember this, as far as the housing market, demand right now is completely being exhausted. The predominant amount of people, not the only people, but the predominant amount of buyers right now are the most well-qualified buyers. And if they're not well qualified, they're having to dig into their parents' money for a down payment. The demand right now is getting annihilated. And then again, if we go to the recession, if we get the credit tightening, if we get the unhinged unemployment, demand is going to stay low. Demand will stay crippled. And if the supply comes back and demand keeps going down, that's when those prices, you guys, collapse. All right. Now, obviously, it's a slow grind. I understand all of that type of stuff. Now, I'm going to go into our first video. Let me know, and I really want you guys to comment on this video. It's going to be from Team Kennedy, and he's going to talk about, how he plans on helping us to buy a house. Again, I believe going into 2024, we're going to hear a lot of politicians start talking about the housing market. So here's going to be our first politician. If you guys can, let me know that this audio is okay. But let's listen to what, let's listen to what the politicians are starting to say that they're going to do to help us in the housing market. And then let's talk about whether or not we think what he is saying is a good idea.
Of 20 and 30-year-old kids who can't afford a house and even can't afford rent and are moving back
audio okay,
in
guys?
with their parents. This isn't happening because young people have suddenly gotten lazy. Monthly mortgage payments for home buyers are up 20% just in the last year. And that's because interest rates have doubled. Meanwhile, the cost of the average home...
You guys, let me get the audio. Yeah, see, I thought the audio was low as well. Let me get the audio fixed real quick. On that, I apologize. Okay, we're ready to go. I'm going to start this over, and let me know that the audio is better if you guys can.
We've all heard stories of 20 and 30-year-old kids
his
who
voice
can't afford to
doesn't
buy
help
a house and even can't afford rent and are moving back in with their parents. This isn't happening because young people have suddenly gotten lazy. Monthly mortgage payments for home buyers are up 20% just in the last year, and that's because interest rates have doubled. Meanwhile, the cost of the average home has gone from $250,000 to $400,000 just since 2019. And those higher home prices have also driven up the cost of rent. So now Americans are paying a third of their income for rent. That's the highest ratio since records were kept. So what's happening? Well, what's happening is BlackRock, State Street, and Vanguard. These giant corporations, which own 88% of the S&P 500, are going into real estate. These investment firms swoop in as soon as a house comes on the market. They outbid prospective home buyers with cash offers. They add that property to their investment portfolio, and then they rent it back to you or your children at the most exorbitant rate that the market can bear. So how can our kids or the typical American homeowner win a bidding war with BlackRock? By 2030, these giant corporations are on track to own 60% of the single-family homes in our country. So BlackRock wants to be everybody's landlord and everybody's neighbor, but I'm not going to let that happen. When I get to the White House, I'm going to restore affordable home ownership to every American, and I'm going to do that without raising the national debt. And here's how I'm going to accomplish that.
Pay attention.
I'm going to create a federal program that backs mortgages at 3% financed by tax-free bonds. These mortgages are going to be available to people only, not corporations. This will drop mortgage payments by more than $1,000 a month for a medium-priced home and allow your children to outcompete BlackRock in the market. So here's how it works. Imagine that you had a rich uncle who was willing to co-sign your mortgage. Well, I'm going to make Uncle Sam that rich uncle. It's not a giveaway. It's a loan guarantee that makes that property affordable to millions of Americans who cannot now afford it. This is just one of the policies that the Kennedy administration will deploy to create millions of new home buying opportunities at payments of less than $1,000 a month. We're also going to change the tax code to get corporations out of the single-family home market. And we're going to work with municipalities to get empty lots and derelict homes back into circulation at low prices. As President of the United States, I'm going to create a housing boom in this country the same way that we did it after World War II when we made home ownership affordable for working people.
All righty. So that's what the politicians are starting to say. Comment below. Let me know what you guys think. Here's my first thoughts on this, guys, and we'll get into our market update. Oh, the 10-year actually reversed. That's interesting. The 10-year was down. It's now up. But, I try to explain this all the time. The 3% interest rates is why we were in the situation to begin with. We had rates that were too low for too long, and it made things unaffordable. Inflation spiked. So the fact that the politicians are trying to go back to that 3%, to me is mind-boggling. We want the prices to go down. We want that deflation, or we want more inventory. So the fact that he didn't talk at all about inventory concerns me, but I did like how he talked about changing the tax codes to make it more unfavorable for corporations to invest. So he hit that nail on the head. But the man mentioned literally nothing about inventory. He mentioned nothing about that. So I feel like it's going to be a circus show. I don't know, guys. Let me know what you think. Let me know if you think that what he was saying was a good idea. And another thing, y'all, which was crazy, is the way that they want to do it. They basically want to give the control to the government. He was saying, give the control to the government. The government is basically going to be the co-signer to your mortgage. How is the government going to be the co-signer to your mortgage? The fact is, you guys, is there's a huge problem in our housing market right now, probably a huge result of corporate greed, which he really didn't talk about that much, and a huge result of the Federal Reserve messing us up. Too much quantitative easing, too much low interest rates. We wouldn't need high interest rates right now, guys, if we didn't have the low interest rates to begin with. Do y'all see what I'm saying? The high interest rates keep us balanced. So I don't know, it's pretty crazy to me. Let's jump into the market right now, you guys. We're going to start with the 10-year. Let me go ahead and timestamp this right now. So we'll start with the 10-year, which tracks pretty much a lot of things. 10 years up. Look at the movement, guys. Look at the movement in the 10-year this morning, okay? When I was preparing for this, the 10-year had dropped, and then it shot back up to almost 4.3 again this morning, which is insane. It shot back down, which is 8 basis points, and now it's back up. The trajectory and fluctuation of this 10-year is so crazy to me, you guys. It takes so much money to be able to make moves like this. Who knows what they're doing to really mess us up? But anyways, the 10-year's up. It started out, look at, going back, from close of the day yesterday, it was down the whole time, and then slightly up, and then just roller coaster ride. And looks like it's on its way up. Pretty good. So that's really interesting. We'll keep an eye on that. This is obviously squeezing everyone. Let's see where the money is going. So here's the reverse repo market. This is where the 1-day money is. A lot of excess savings is here. And, day over day, it actually went up. So yesterday they put more money than not in the reverse repo market. And it's probably because the market expects rates to be higher. Like if the market doesn't expect rate to be higher, then you're going to see this right here. So basically what happened in like mid-July right here to like late August is the market was anticipating they're going to hike rates. So they wanted to wait to take the money out of here to put it in the longer term yields. Now around, August 23rd, they're like, okay, we're almost done. We're almost done. And then the money starts leaving. But we had the CPI report come out yesterday, a little bit hot. And so that money has stayed into there. Now, that's only a day. There's no trends yet, obviously. But it's really interesting to watch this money, right? Well, let's watch where the money is going. Now, let's look at the expectations of the market, which is also astounding. What is going on right now, you guys, is it's just so amazing to me. What this is saying right here, this 5-year break-even inflation rate, this is saying that the market thinks that there's more work to be done. There's more work to be done so long as the Federal Reserve, thank God, keeps the inflation target at 2%. This has been going up. This has not been going down. And after we got the CPI report yesterday, this went up even more. So before the Federal Reserve, okay, probably more than likely before the Federal Reserve even starts to cut rates, this is probably going to be under 2. Okay, so right now it's at 2.28. So keep your eye on that. But that's headed up. That's crazy to me. Again, you guys, with all of the corporate bankruptcies, with unemployment starting to skyrocket, like all of these things going on, inflation's still out of control. Isn't that crazy to you guys? So they are not done. This is what it's showing us. And we could tell them they're not done just by looking at the housing market. Now look at the yield inversion. So basically yesterday, it kind of stayed flat. It wants to reinvert, but it's probably going to reinvert the higher the 10-year gets. So the higher that 10-year treasury gets, the closer, in my opinion, this is going to get to reinversion. But this is the 10 and the 2-year. Obviously, this is an economic indicator of an incoming recession, and we do want to pay attention to this. Now, let me show you where mortgage rates are at, you guys. Mortgage rates are at 7.22 right now. You guys can see that under my head right there. And that's for like the cream of the crop. It says the average mortgage rate. But I could tell you right now from being in the industry that the average interest rate is generally quarter to 50 basis points higher than what's marketed, unless you have like the perfect situation, which is always why I'm preaching to you guys. If you're on the sideline, put yourself in a perfect situation because you ain't got nothing else to do but improve your situation. But anyways, guys, we're sitting at 7.22%. And again, listen to what I said, all right? Part of what I'm trying to do here, you're not just going to get headline stuff. I'm going to try to like inject some value, and some of the value that I want, I hope you guys are getting is how to review your localized market. And by understanding how to review your localized market, you don't have to depend on me. You don't have to depend on any YouTubers, any economists, any realtors. Unless you need access to MLS, you get to depend on you. And that is the goal here. Okay. I'm trying to just sweep that under the rug. And I want each and every one of you to wake up and to end my videos like, wow, I know more. And if we do that, then we're winning no matter what. Even if they pushed out the recession, we had the bailout, we didn't get the price decline like we wanted, it doesn't matter. As long as you're empowering yourself, your day will come. Okay. That's all I wanted to say there. Now we're going to go into our second video, you guys. I love this video. I really hope you guys like this video. This video is a good video. I have it linked in my description. This is from Rebel Capitalist, okay? Now, I'm going to warn you guys, okay? I want you guys to follow along. This is a 7-minute video. It's a little tad boring, but I promise you, if you guys make it through this video, your mind's going to be blown. He does an exceptional job at breaking down where we're at right now with supply and demand. Because how many times do we hear people in the bulls like, oh, it's about supply and demand, it's about supply and demand, right? Yeah, we get it. But there's things affecting the supply and demand, right? So he does a great job, you guys. I think you're going to find this video extremely, extremely valuable. Try to make it through the 7 minutes. If you can't make the full 7 minutes, you guys come back here and watch this. But this is the man, probably one of my favorite YouTubers right now. His channel is Rebel Capitalist. Absolutely love this guy. Very charming, very down to earth. Doesn't have a huge ego. Like, I'll settle with no huge ego. If they don't have huge egos and they got good content, like, I'm sold, right? These egos. And you guys saw my poll yesterday. I won't even go into that. Hey, I see the super chat. Appreciate your support. Send me a comment though. I wanted to hear what you have to say. Appreciate it. Thank you for the super sticker. Definitely appreciate that. Let us know how real estate's doing out there as well. So again, you guys remember 7 minutes. Okay, and again, this is a 16-minute video. I'm only playing 7 minutes. Go back to this man's channel and subscribe to this man's channel. This guy is a jewel. This guy is a jewel. I hope you guys enjoy this.
He's talking about. And at the end of this video, I'm going to reveal how far prices could go down. I'm going to do this in 3 simple, fast steps. Step number 1, let's go over housing market price dynamics. In other words, what makes prices go up and what makes them go down. Well, everyone knows that we got to start off by talking about supply and demand. But it's not just supply and demand in and of themselves. You can't compartmentalize supply and compartmentalize demand. You have to look at the relationship between one another. Let me show you what I'm referring to. Let's look at a chart going all the way back to 2002 to today's date. On the left, we go from 0% up to 250%. This black line represents CPI, the official headline inflation number given to us by the government. The red line indicates home prices. Now, these are nominal prices, and we can see in this chart how high prices went relative to the inflation rate, let's say in 2006. And everyone knows what happened then. Once we hit 2006, prices went all the way down and didn't go back up until 2012. Well, what happened here? Okay, well, a lot of you would say, well, there was excess supply and everyone was building a house and all these liar loans. But at the core of the price movement, what happened is demand dropped relative to the amount of supply. And you'll notice that prices were, let's say, at 100% where they were in 2002, and inflation was nowhere near as high. In other words, the home prices went up a lot faster than the rate of inflation. And another way to look at this is we have to understand that wages, incomes, usually go up with the rate of inflation. Now, it is true, when we get severe inflation, like we've seen over the last couple of years, incomes do not go up at the same rate. But usually, if inflation is going up slowly, incomes stay right around the same level. So if we look at the prices and see the delta between the CPI, effectively what it's telling us is that there's the same delta between prices and incomes. But let's fast forward to what we see today, where it's obvious, just looking at this chart, that prices are much higher relative to incomes and the CPI than they were in 2006. So what I always say is, if we were in a bubble back here, what are we in right now? Are we in a healthy housing market? And the rebuttal that you'll always get, well, it's supply is tight. We're at historically tight supply, and therefore the prices make sense. Okay, but what you're doing is you're taking the recent past and extrapolating that indefinitely into the future. And I think this is a huge mistake. Let me show you what I'm referring to specifically. So this is a simple chart, and the blue line represents demand. The red line represents supply. So you can see, even in a market where demand is going down significantly, you can still have prices go up if supply is going down at a faster rate. But the question becomes, what happens when supply goes back up, especially considering the fact that demand is being exhausted. It's almost gone. Why? Because the affordability is just completely out of reach for most Americans when you consider the prices and the interest rates. But the key takeaway from this little chart is to realize that although prices are up, demand is down, and it's way down. So now let's think through.
And you guys, I just want to say, I'm going to take a break real quick. Just want to make sure you guys are understanding what he's saying. And then also let's understand that the data that we're basing all of this information off of is data we can't even trust. So if he's using data, say wherever they're using data, we know that really, and I hope you guys have seen it, the real data is on MLS. So I suspect that this situation is much worse than what he's even explaining it to be. So in other words, you guys, I believe we have a lot more inventory and supply than what the market is allowing us to believe. In fact, I know that 100% because I've flown and went to new construction developments in multiple states, and I have seen multiple properties that are not listed on MLS. So understand what this man is saying. And again, it's going to get really good right now. But what I like that he said so far is in regards to supply and demand, prices can still go up even when demand crashes like it is right now, if supply goes down faster than demand. Although I don't think that's what's happening right now. That I like how he's explaining it. Let's finish this.
How prices are actually set in the real estate market. This is interesting. So let's just assume for a moment this is the entire housing stock in the United States. So these homes, or at least the housing stock that is not currently for sale. So right now we've got about 140 million homes in the United States. And let's just assume, for the sake of this example, we'll keep things super simple, that the entire housing stock is just, let's see, 3, 6, 8, 10, 13, 14. And 13 of these houses are not for sale, but one is. So if there's only one house for sale, you don't need much demand. In fact, demand can go way, 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 way down, and still prices will go up. Well, how will the prices for all these 13 homes go up? Because they're based on the comps for this one house. In other words, prices are set at the margin. So let's say this one house sells for $200,000 based on current demand, which is incredibly low. Well, what happens if one more person sells their home? So instead of one house being for sale, now we have 2 homes for sale. Well, you'd say, George, well, the price would probably go from maybe 100,000 down to 75,000, maybe down to 50,000 if there's only one buyer, but now he has 2 options. Okay, well, that means that the entire value of these other 13 homes would be cut in half. They would go from 100,000, or let's say 1.3 million, because we've got 13 homes, all the way down to, let's say, 650,000. So now that you understand the concept, let's go over some real numbers. Right now, in the housing market, we have 140 million homes, roughly, like I was saying earlier. Only 650,000 of them are for sale. And you say, well, George, okay, give me some context there. How many are normally for sale? 1.2 million is the normal when you go back to 2019. So let's just think this through for a moment. If prices are right here, based on 650,000 homes being for sale, where would prices be if we had 1.2 million homes for sale? Answer: way, way lower. And that's a technical term. You'll only hear that on the George Gammon channel.
All right, guys, tell me what you thought of that. I absolutely love that breakdown. To me, what that's showing is how little inventory we actually need. Again, if we just look at the rules of supply, a law of supply and demand, all we need is a little bit of inventory for house prices to come crashing down. Think about what he's saying and think about how much vacant inventory, think about how much forced selling there is in every single housing market. Every single year there's forced selling. Okay. And then what else is happening right now? 1 out of every 10 home sellers right now are being called back to work. 1 out of every 5 home sellers right now are selling because they can't afford to be a homeowner anymore. Things are changing like crazy and the consumer is getting beat down, you guys, but hopefully we're not getting beat down so much to where we still can't take advantage of the opportunities that are coming, which they are coming. Let me show you guys where we're at with inventory. This hasn't updated yet. This is as of basically August 31st. Oh, you know what? I apologize. This is for Texas. Oh my gosh. Okay, so let's just look at the inventory for Texas. Everyone's like historical low inventory. Dude, in Texas, we haven't had this much inventory, you guys, since March. Was this March? I'm sorry, May of 2020. We almost have more active units in Texas than we did pre-pandemic. Do y'all see this? What are these people talking? Like, I feel like these people are really trying to trick us. I'm not gonna lie. Like when I pulled up just Texas, I was like, wait a minute. Everyone is saying that everywhere, limited inventory, blah, 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 right? But the reality is I'm almost at pre-COVID levels right now in the state of Texas. In other words, you guys, here's the thing. We got to do a better job at finding the trends in our local markets. And we got to do a better job at finding those trends without using Redfin, Zillow, CoreLogic, Black Knight, and those companies. And for example, use Fred, right? Fred uses realtor.com. So, I mean, they're all using someone, but we need clean data. The data that we're reviewing, the headline data is tainted. The headline data is not clean data. And when we think about it, I understand why that is, and I understand how they're doing it. And I'm going to do another video again later today on the Redfin report that just came out. You guys, total BS. It's total BS because they're manipulating the visualization of the data. They're making it appear that house prices aren't going down when they are. So they're making it seem plateaued, but reality is they're actually going down, and they're actually down 2% off peak right now. 2% off peak right now. I'm just talking about existing inventory. We're 2% off peak already. And we can't see it in their charts. But anyways, guys, I'm going to go in now. Let's listen to what he has to say. So we're going to listen to this video right now. This is from Yahoo. This is going to be an interview of Glenn. And I'm going to be honest with you guys. He looks beat up. Glenn definitely looks beat up. Now, here's the thing, guys. Listen to what he has to say. We're going to go into a Redfin database after this, and I'm going to show you guys that what he's saying is not true. But listen to what this man is saying.
Above 7% low inventory and rising prices. Just this week, pending home sales are down 14%. Now that's a 14% decline from a year ago. Joining us now, we want to bring in Glenn Kelman. He's the CEO of Redfin. So Glenn, the big question is here is what is this cooling effect? How big of a cooling effect is this going to have on the housing market? What do you think?
Well, rates have been high all year. They peaked in August. They seem to be easing slightly now. So I don't think sales volume could go any lower. And prices are actually headed up.
Sorry, I just wanted to point out, he said he doesn't think sales can go any lower. And he just said prices are going up. The reality is sales are getting lower and prices are going down. Y'all heard him say that. Okay, remember that. He said it. Okay, he said prices are going up and sales can't go any further. I'll show you otherwise after the video.
Because inventory is down. So I think the market is in a holding pattern, waiting for a break from the Federal Reserve.
As are so many other sectors, Glenn. It's been interesting to see how home buyers, as well as builders, have tried to work around the rates as well as inventory levels. We have seen an incredible buildup in new construction, new homes. You've talked, though, about this generational shift that is happening right now as a result of lack of affordability, as well as just the lack of opportunity to buy homes. I wonder if you can touch on that, because we sort of talk about homes day in and day out, but what is this long-term shift that we're seeing as a result of where we are today?
Well, it's decline in the American dream, isn't it? At this point, 30 years ago in their life cycle, baby boomers own more than 20% of US national wealth, whereas millennials own less than 10%. And it's simply because millennials can't afford a home. We pulled the ladder up just as millennials were coming of home buying age. Home prices shot through the roof, then rates shot through the roof. And now there's so many people who want to move and can't. There is still unfinished business in this country where people want to leave the coastal cities for less affordable parts of the country, but those for more affordable parts of the country, but now the more affordable parts become less affordable too. And so really, it's just a case of arrested development where people who want to move can't, and it's a tragedy.
So then, Glenn, how does this play out?
Well, you just see lower household formation, more people living with mom and dad, shacking up with roommates instead of striking out on their own. It's one reason why family formation is down. People aren't getting married as much. They aren't starting families and having children because they just don't have the living space to do this. And so I think that housing is a basic human need. We are going to see more people looking for homes. The real issue is inventory. There's so many folks who want to move up who aren't putting their homes on the market because they can't even afford the place they have now. Interest rates have gone up so much, they are loath to leave behind that 3% mortgage rate. And so the real crimp in the industry isn't actually demand, it's supply. There's not much of either, but there's especially low supply with new listings down more than 10% year on year. And that was from a low in 2022.
Glenn, what has all this meant for your business on Redfin?
It's been a wild ride. So sales volume is around 4.1 million units, and we've had to make adjustments just because we employ our real estate agents, and that means that we have to keep them busy. So we went through a couple of layoffs at the end of last year. We're doing better now. We expect share to increase in the second half of this year, but it's been very disruptive. And yet, we still believe there's just a better way to buy or sell a home, that you can sell it for 1%, that you can get better service, that you can click a button to see into a property, or excuse me, to go tour it. So all of those things are still true. It's just hard to be a publicly traded company when you're in a very cyclical seasonal business. We're going to see it through, though.
Glenn, when it comes to those people who are still out there looking for homes, they're still maybe among the buyers that are able to afford this. What's the demographic there? What are you seeing in terms of the people that are able to afford and where they're buying?
Well, some of them are Nepo home buyers, people who are borrowing money from mom and dad. So traditionally, America has had more class mobility than anyone else just because we've had more land. People have been able to buy into the American dream with a very small down payment. But because we tightened credit after the great financial crisis, and now we've got rates where they are, the only people who can buy a home often are the people with cash in hand. And that either means older people or children of wealthy people. So we're just seeing an increase in cash buyers and a decrease in everyone else who has to get financing.
What about for developers? I mean, are you seeing, sort of investors kind of pull out of the market because the upside isn't as significant, the inventory or the opportunities just aren't there? What are you seeing on that front?
Well, it's a tale of two investors. So the home builders are doing really well. A third of new listings are new construction listings because traditional listings that are coming from people who own a home just aren't on the market. People have decided to stay off the market because they want to keep that 3% mortgage. And so the builders have really got a monopoly on the attractive inventory, and more people than ever are buying new construction as a result. But if you're talking about investors who are Airbnb investors, where they're buying a home and flipping it, for the first time, we've seen them come under some duress. If you go to these really bubbly markets like a Boise or an Austin, they haven't been able to get the rent. They're trying to sell the property, and sometimes they're bringing cash to the closing table. Mostly, we haven't seen the kind of distress that marked 2008, which created all this inventory when no one else wanted to sell, foreclosure, short sales, and all the rest. But the investors who are trying to make a mint by creating an Airbnb empire are, in some places, just a few, starting to get upside down.
Glenn, going back to what you said earlier, when we talk about the tight inventory, obviously pushing prices higher, how much higher, I guess, how much longer do you see this trend staying intact?
Well, you tell me, when is the Federal Reserve going to lower rates? I know that the employment numbers eased a little bit, but mostly it's really a tale of two economies too, that the rest of the economy is doing really well, which means that the housing economy isn't likely to catch a break by the end of 2023. Rates are going to stay around 7% or higher for the rest of the year, as far as we can tell. And I think until we get some rate relief, we're not going to see more inventory because people are going to want to hold on to their loans. And we're not going to see that much demand because so many people just can't afford the mortgage payment.
So here's the thing, you guys, it's crazy. But what we're talking about here is we're talking about forced selling. A lot of these people are assuming, oh, why would people want to sell? Why would people want to sell? That's not what I'm talking about. I'm talking about the people that don't want to sell, that have to sell. That creates forced selling. That creates, unfortunately, and I went through it myself, it's very unfortunate, it creates foreclosure. And one of the things that if you play that video back, that he's talking about now is finally, it took a minute, but the STR, short-term rental market, like VRBO and Airbnb, is starting to crack and fall apart. And not just because of potential recessionary headwinds, also because there's multiple metro areas, including my neighbor Dallas, that have completely banned and re-regulated zoning. So you can't even run an Airbnb in a residential neighborhood. So yes, okay, vacancies are down. We get it, right? This types of stuff. But I'm looking at like it's illegal. And they know it. And I think what's going to happen, guys, until they start really cracking down on STR, a lot of those STR owners and Airbnb owners are just going to try to continue to keep things as is. It's not till they start getting hit with fines that it's really going to domino effect. Once your friend gets popped for Airbnb, you're going to freak out a little bit. And the thing is like if you guys own an Airbnb, if anyone watching this owns an Airbnb in one of those, metros, if it's me, I'm converting immediately because you don't want to get blindsided. You want to do this stuff before we have a total collapse, right? Because think about it. There's going to be an influx of Airbnb owners once they freak out and that sentiment starts to shift that list their properties at the same time, whether it's a long-term rental or whether they're listing the property for sale. So again, if I'm an Airbnb owner in Dallas, New York, hopefully Phoenix will start this. What is it? Las Vegas. I'm doing something about it. For sure. I'm not going to get blown in the wind. And I'm telling you guys, some of these people are going to get blown in the wind. Now, let me show you some data, if I may, from Redfin, because this just came out. So just remember, you guys, Glenn said that home prices are still going up. But the reality is, and I'll make a report on this, actually home prices are going down. And thank goodness, because like, what the heck? Now, it went down about $2,000 week over week. And the thing that I'm really trying to tell you guys, look at this, okay? I want you guys please to just bear with me. You see this? This is from week to week right here. That flat line represents a decline of $2,000, and they do not show it on the visualization of this data. That's what I'm trying to tell you. There was a decline of $2,000. We should see the week to week go down, but they don't show it going down, you guys. They're showing it sideways, even though prices went down $2,000. Okay, this data is nonsense, you guys. This data is nonsense. I don't know how else to say it to you. Remember, I showed you guys Zillow as well. Zillow is just jacking up prices. Redfin is hiding information. And think about this. Remember, they shut down their data reporting system for about 4 weeks. Let me explain how this works. Okay, as a loan officer, I use something called automated underwriting system to run people's file through underwriting to make sure they can afford a house. But my lender, the lender I work for, can go into that system and change and tweak the algorithm, okay, to make it either easier or harder for people to get approval. Now, likewise, Redfin or Zillow can do the same thing. And understand this, there's probably 600 or more, there's hundreds of MLS, okay? All Redfin has to do is stop using a certain MLS to manipulate the numbers. They could literally turn things on and off and hit levers to manipulate the data. That's a reality, you guys. That is a fact. And honestly, ask yourself this question. Do you think we're not asking if they can. We already know it's their algorithm. They can do whatever they want. But let me ask you guys, do you think they are? And why do you think they would be motivated to? Think about that, all right? Probably because their stock is like being gutted right now. Who knows? But anyways, guys, I really hope you guys got the value today. I really try to be, just Johnny on the spot with the value. I'm going to try to do another live tomorrow. I want to finish out this week doing a live every single day during the weekday, not the weekends. So I'm going to hopefully get you guys something spicy tomorrow. But again, this is all new data. We didn't even listen to CNBC. I want you guys to do good. Don't forget, you guys, okay, how important you are. All right. Happy Thursday to you guys again. Keep working your goals. All right. And probably tomorrow, what I'll do, guys, I'll probably do a quick market analysis just to show you guys once again how important localized data is. And other than that, you guys, if you're out there investing in real estate, you already know I wish you luck. And I hope each and every one of you